You're staring at a rental listing on your phone at 11:47 p.m. Duplex $210,000, tenant occupied on one side, and your checking account says $1,380. That's it. That's the whole war chest. You screenshot it anyway, like saving the photo makes it more real, like the bank will look at a screenshot and decide to believe in you. This is level 1. Everyone starts here. No credit history worth mentioning, no capital, no deals, just a phone full of numbers that don't work yet, and a stubborn refusal to close the app. The problem at level 1 isn't ambition. You've got plenty of that at midnight. The problem is math. Every guru on your feed is talking about cap rates and 1031 exchanges like you've got a portfolio to defer taxes on. You don't. You've got a car payment and a Roth IRA with $340 in it that your coworker talked you into opening 2 years ago. Real estate at this level isn't about strategy. It's about finding a crack in the wall wide enough to fit your fingers into. That crack has a name: house hacking. It's the cheat code nobody explains right because it sounds boring compared to I closed on 12 doors this quarter. House hacking means you buy a duplex, triplex, or fourplex, move into one unit yourself and rent out the rest. You get an FHA loan doing it, 3.5% down instead of the 20% every conventional lender wants from an investor. On that $210,000 duplex, that's the difference between needing $42,000 you don't have and needing $7,350 you might actually be able to scrape together in a year if you stop ordering DoorDash 4 nights a week. The bank treats you like a homeowner, not an investor, because on paper that's exactly what you are. You just happen to be a homeowner whose neighbors pay half your mortgage. Finding that $7,350 is its own grind, and nobody romanticizes this part because it isn't glamorous. It's a second job delivering groceries on weekends. It's selling the motorcycle you barely ride. It's asking your cousin who works in logistics if he wants to split the down payment 50-50 on a handshake and a notarized agreement, because partnerships at this level aren't Wall Street partnerships. They're two people who trust each other enough to pool $3,675 apiece. Some of you will find a seller who's tired, an old landlord who wants out without paying an agent, and he'll carry the financing himself, take payments directly from you instead of sending you to a bank at all. Seller financing sounds like a unicorn until you actually go door knocking on off-market listings and realize tired sellers are everywhere. They're just not on Zillow. Say you land it, say you actually close on the duplex, or the fourplex if you found a seller desperate enough and a lender patient enough. This is the moment everyone imagines feels like winning. It doesn't, not yet. It feels like moving into a building with someone else's problems attached to it. You learn cash flow the hard way, which is the only way anyone learns it. Rent minus mortgage minus taxes minus insurance minus the water heater that dies in month 3 isn't some clean formula on a spreadsheet. It's you standing in a Home Depot parking lot at 7 a.m. on a Saturday, calculator app open, doing math you should have done before closing instead of after. You learn that $1,800 in rent doesn't mean $1,800 in your pocket. It means maybe $340 after everything real gets subtracted, and that $340 has to survive whatever the building throws at it next. And the building will throw things at it. This is where level 1 eats people alive. The mistakes here aren't exotic, they're painfully simple, and they wipe out more beginners than any market crash ever will. Bad tenants top the list. You get excited, you skip the background check because the applicant seems nice and you need the unit filled yesterday, and 4 months later you're eating a $4,200 eviction and a trash kitchen because you wanted to trust your gut instead of a credit report. Then there's the reserves problem, the one nobody warns you about loud enough. You put every dollar you have into the down payment and closing costs, and you've got $200 left over for the day the roof leaks or the furnace quits in January. It always happens in January. The investors who survive level 1 aren't the smartest ones in the room. They're the ones who kept 6 months of reserves sitting untouched in a separate account they were tempted to raid a dozen times and didn't. You'll also overpay at least once. Everyone does. You'll fall for a listing photo, skip a real walkthrough of the crawl space, and find out later the foundation needed $14,000 of work, the inspection report buried in paragraph 9. That mistake doesn't kill you if you built in reserves. It absolutely kills you if you didn't. But here's what nobody tells you about crossing the finish line at level 1, the moment your portfolio value actually clears $1 million. It doesn't feel like fireworks. It's not one big transaction, it's the slow accumulation, maybe 2 or 3 small multifamily properties, house hacked and refinanced and house hacked again, tenants paying down debt you didn't have the cash to pay down yourself. One day you pull the numbers, add up what the properties are actually worth against what you owe on them, and the figure on the screen says 7 digits, and you sit there in your car in a driveway that isn't even the nicest one on the street, feeling something shift. What changes at $1 million isn't your lifestyle. You're probably still driving the same car with the check engine light you've been ignoring. What changes is your access. Lenders that ignored your calls now return them same day. Banks that wanted 20% down on principal now want to talk about portfolio loans. Other investors who wouldn't return a text a year ago start asking what deals you're looking at next because you're no longer the guy with a screenshot and $1,380. You're the guy with proof. You cracked the wall. Now the question is whether you can walk through it fast enough before the door closes, because level 2 doesn't wait around for anybody, and the rules you just learned are about to get rewritten completely. Level 2 doesn't announce itself with a ceremony. It shows up as a spreadsheet tab you didn't have before, labeled Deal 4, sitting next to 3 others that used to feel like the entire empire. You're not the guy with a screenshot anymore. You're the guy lenders call back. And the first thing you learn at this level is that the game you just beat wasn't the real game. It was the tutorial. The mechanic that unlocks everything here has a name that sounds like a stutter. BRRRR. Buy, rehab, rent, refinance, repeat. At level 1, you bought a duplex and prayed the numbers worked. At level 2, you buy a property specifically because the numbers don't work yet, because it's ugly, vacant, priced under market for a reason you can see and fix. You close on a fourplex for $340,000 in a neighborhood 2 blocks from one you'd already proven cash flows. You put $60,000 into new roofs, updated units, a kitchen that doesn't look like it was finished in 1987. 6 months later, an appraiser walks through and tells you the building is worth $460,000. That gap between what you owe and what it's worth, that's not theoretical money anymore. That's a refinance away from becoming your next down payment. You pull cash out through a cash-out refi, pay off the private money or hard money loan you used to acquire and rehab it in the first place, and suddenly you're holding a check for $85,000 that didn't exist in your bank account yesterday and didn't cost you $1 of new savings. You didn't sell anything. You didn't wait for a bonus. You just told the bank the truth about what your work made a building worth, and it paid you for knowing that before they did. Then you repeat it. That's the whole trick. It sounds almost too simple written down, and it is simple right up until you get the timing wrong and you're carrying 2 mortgages on a rehab that's taking 4 months longer than the contractor promised. This is also where you stop buying duplexes and start buying buildings with names. The 12-unit on Ellison Street, the 8-unit everyone in the local investor group just calls the brick one. Small multifamily is a different sport than a fourplex. Vacancy isn't one tenant skipping out on you, it's 3 units empty at once during a slow season and a property tax bill that doesn't care that February was slow. You learn this the expensive way when a 10-unit you bought at 92% occupancy drops to 70% within your first 2 months of ownership because the previous owner was quietly not renewing leases to make the seller disclosures look cleaner than reality. Nobody warns you that people lie in this business the same way they lied at level 1. They just lie with bigger numbers now. You can't run this alone anymore, and pretending you can is how level 2 operators quietly go broke. You build your first real team here, not friends doing favors, an actual team. A property manager who takes 8% of collected rent and, more importantly, takes 2 a.m. phone calls about a burst pipe so you don't have to drive across town in your pajamas anymore. A contractor you don't have to supervise line by line because he's proven himself on 2 rehabs already and texts you photos unprompted. A lender who knows your name before you say it, who explains portfolio loans and DSCR loans to you like you're a colleague instead of an applicant. This team costs you real margin. It also buys you back your weekends, and at this level you start understanding that time is the actual currency you've been trading the whole time, not cash. Then leverage introduces itself properly, the way it always does, without an invitation. You refinanced a building at 5.75%, felt like a genius, and 18 months later rates have moved and your adjustable piece resets at 7.4%. Suddenly, a building that cash flowed $1,200 a month is cash flowing $310, and one slow-paying tenant or one HVAC replacement away from cash flowing nothing at all. You feel, for the first time since that duplex at midnight, actual fear about actual money, except now the numbers have more zeros attached and the mistake, if you make one, doesn't just cost you a security deposit. It costs you a building. You learn to build in rate buffers to stress test every deal against a worse version of itself before you sign anything. Because at level 1 optimism was fuel, and at level 2 optimism without a spreadsheet behind it is how people lose everything they built. You also stop finding deals on Zillow entirely around here because the good ones stopped showing up there months ago. You start showing up to a local investor meetup in the back room of a diner every third Thursday, 12 people, bad coffee, somebody always pitching a syndication nobody quite understands yet. That room is worth more than any listing site. Off-market deals start finding you instead of the other way around. A wholesaler texts you first because you closed fast on the last one he sent. A broker calls before a pocket listing ever gets photographed because he knows you don't waste his time. The deals get quieter and better at the same time, which is exactly how this level is supposed to work. Somewhere in there, without one single dramatic transaction, you cross $10 million in assets. It doesn't feel like the duplex moment did. There's no driveway, no gut check pause. It feels more like realizing you haven't personally shown a unit to a tenant in over a year, that you spend your time reviewing management reports and rate locks instead of unclogging toilets. You're not managing properties anymore. You're managing people who manage properties, and operators, not landlords, are the only ones who survive what's waiting at level 3. Level 3 doesn't start with a bigger building. It starts with a phone call where someone else's money is on the line instead of yours, and you realize halfway through the conversation that you're not asking permission anymore, you're asking for capital. Here's the wall you hit at $10 million. Every deal above a certain size stops caring about your W-2 or your personal balance sheet and starts caring about something you don't have yet: other people's trust in your ability to not lose their money. A 120-unit complex doesn't sell for $340,000 the way your first fourplex did. It sells for $14 million, and no bank on earth is handing that to a guy who's been writing his own checks for 4 years. So you stop being the only source of capital on your deals, and you become the person who finds the capital, structures the capital, and answers for the capital when it goes sideways. That's the entire shift. You go from investor to sponsor, and nobody tells you how much heavier that word actually is until you're the one signing a personal guarantee on a loan with 8 zeros while somebody's retirement account sits inside your deal. This is where you learn the letters that run this whole level. GP and LP. You become the general partner, the operator, the one who finds the deal, underwrites it, signs the debt, and manages the asset day to day. The limited partners are the money, the dentists and the retired engineers, and the guy who sold his software company in 2019, all of them writing checks of $50,000 or $100,000 or $500,000 into your deal, because they want the returns of real estate without the 2 a.m. phone calls. You take a fee for putting the deal together. You take a cut of the profits above a certain return threshold, what the room calls the promote. And in exchange, you carry the weight when the elevator breaks or the market turns, because their money isn't a loan, it's an investment, and investments can lose. Your first syndication is a 96-unit value-add deal in a submarket you've watched for 2 years, waiting for the right seller to get tired. You raised $2,800,000 from 11 investors, most of them people from that same diner meetup that used to feel like the entire ceiling of your world. You put together a deck with rent comps and a business plan and a sensitivity analysis, and you present it in a conference room you rented for the afternoon, because your actual office is still a spare bedroom. Somebody asks what happens if interest rates spike during the hold period. You have an answer ready because you learned that lesson at level 2 the expensive way. That's the moment you understand track record isn't a resume line, it's the only collateral you actually have. The underwriting itself gets a new gear entirely. At level 2, you were running numbers on a spreadsheet you built yourself, checking rent comps by driving past 3 buildings on a Saturday. At level 3, you're underwriting a 150-unit complex with a $6,200,000 renovation budget, and the mistake that used to cost you a slow month now costs your investors their principal. You start hiring a real analyst. You start pulling third-party rent surveys instead of guessing. You stress test every deal against a recession scenario before you ever put it in front of a single investor, because the difference between level 2 and level 3 isn't the size of the buildings, it's the size of what happens when you're wrong. The lenders change too, and this is the part that quietly tells you you've leveled up before your bank account does. Local banks stop being the ceiling. Life insurance companies and Fannie Mae and Freddie Mac start returning your calls. Agency debt, the kind with 10-year terms and non-recourse structures that didn't exist for you at $2 million in assets. But institutional lenders don't lend against enthusiasm. They lend against a track record measured in completed business plans, in deals you took from acquisition to stabilized exit without blowing up somebody's capital along the way. Every deal you close clean becomes a rung on a ladder you didn't know you were climbing until a loan officer mentions your last 3 projects back to you like he's been keeping score the whole time. Somewhere around your third syndication, you stop outsourcing property management entirely and start your own management company instead, because the 8% fee you've been paying someone else to run your buildings is now large enough to justify hiring a team that answers only to you. This isn't a side project, it's a control move. When you own the management, you control the reporting your investors see, the renovation timeline, the leasing velocity, the entire narrative of whether the deal is working. The operators who skip this step stay dependent on someone else's competence forever. The ones who build it become the actual product investors are buying into, not just the deal, but you. None of this is safe, and level 3 will teach you that the hard way if you let your guard down. Over-leveraging kills more sponsors at this level than bad deals ever do, because the debt is bigger, the bridge loans are shorter, and a rate cap that expires at the wrong moment can turn a stabilized asset into a distressed sale overnight. Bad partnerships kill the rest. A GP who cuts corners on reporting, a co-sponsor who disappears when a capital call goes out. And market downturns don't ask if you're ready. They just arrive, the way they did in 2008 and 2020, and separate the operators who underwrote conservatively from the ones who were only ever betting on rent growth continuing forever. But if you survive it, if you raise the capital, close the deals, keep your investors whole through at least one bad quarter, something shifts permanently. Your portfolio crosses $100 million in value, not because you got lucky on one building, but because dozens of people trusted you with theirs. You're not a landlord anymore. You're not even really an investor anymore. You're an operator with a track record, and level 4 is where that record becomes the entire currency of the empire you're about to build. Level 4 doesn't start with a bigger deal either. It starts with a meeting where someone slides a business card across the table that says Chief Investment Officer, and you realize the conversation isn't about one building anymore. It's about all of them at once as a single machine. Here's the wall you hit at $100 million. Every deal you've closed up to this point has been evaluated on its own, a spreadsheet, a rent roll, a debt stack, judged in isolation like a single hand of blackjack. But above 9 figures, nobody's grading the hand anymore. They're grading the dealer. Institutional capital doesn't ask if your 96-unit deal in the numbered submarket cash flows. It asks what your portfolio looks like across markets, across asset classes, across economic cycles, because the money at this level isn't chasing a return, it's chasing a system that survives contact with a recession. You stop being a sponsor with a good track record. You become a portfolio company, and the difference between those two things is the entire chapter. You feel the shift the day you stop calling it my deals and start calling it the platform. You've got 340 units in Texas that came online through your first 3 syndications, another 600 units across 2 Southeast markets you picked up when a competitor's fund got margin called during a rate spike, and now you're underwriting your first industrial flex park, a 280,000 square foot logistics play near an interstate interchange that has nothing to do with apartments at all. Your investors used to ask you how the 96 unit was performing. Now they ask how the portfolio's blended cap rate looks against the risk-free rate, and you have to have an answer that spans 5 markets and 3 asset types in one breath. Diversification stops being a buzzword you nodded along to in a webinar and becomes the actual thing standing between you and getting wiped out. A single market downturn used to be survivable because you only had skin in one city. At $100 million plus, a single market downturn can be existential if you're concentrated, because now the exposure isn't measured in one building's debt service, it's measured across a fund with hundreds of investors who all read the same headline about the same city on the same morning. So you spread it: multifamily in the Sun Belt, industrial near port cities. A little self-storage because it's boring and it barely notices a recession. You're not doing this because it's exciting. You're doing it because the operators who stayed concentrated at this size are the ones who get written up in the trade papers 2 years later as cautionary tales. Their names attached to a fund that got frozen because 80% of it sat in one overheated metro that cooled off 18 months too soon. The financing changes shape again too, the same way it did at every level before this one, except now the letters on the term sheet get longer and the rooms get quieter. Life insurance companies and agency debt were the ceiling at level 3. At level 4, you're sitting across from private equity shops with dedicated real estate arms, family offices managing generational wealth for people whose last names are on hospital wings, sovereign adjacent capital that moves in increments of $25 million like it's nothing because relative to the fund, it isn't. You start structuring joint ventures where you bring the operational expertise and deal flow, and the institutional partner brings the bulk of the equity, a 90-10 or 85-15 split that would have sounded insane to you at level 2, when $2,800,000 from 11 LPs felt like the biggest number you'd ever say out loud in a rented conference room. Now you're the one saying $80 million in a boardroom and not blinking because the number stopped being the scary part. The scary part is what happens if you're wrong at that scale and you already know that answer from level 3. It just costs more zeros now. Exit strategy becomes a real discipline instead of an afterthought you'll figure out when a deal matures. At $100 million, you're thinking in 3 lanes at once. Refinance the stabilized assets to pull equity out tax-free and redeploy it into the next acquisition, the move that lets you compound without constantly going back to the well for fresh capital. Sell the assets that have hit their business plan ceiling, take the gain, recycle it into markets with more room to run, the move that keeps the portfolio from calcifying into buildings you're only holding out of habit. Or hold, flat out hold, the trophy assets, the ones you're not selling in your lifetime, the ones you're structuring inside a family limited partnership or a trust because the entire point of them was never the cash flow. It was the thing that outlives you. Generational wealth isn't a phrase you understood at level 1 when $340,000 felt like the ceiling of the universe. At level 4, it's a legal structure with your kids' names quietly written into it. Here's what actually separates the operator sitting at $100 million from the empire builder sitting at $500 million. It isn't more deals, it's not even more capital. It's whether you built a company that runs without you standing in the middle of every transaction, whether the acquisitions team can underwrite a deal in a market you've never personally visited, whether the asset management reporting goes out to 200 LPs without you personally checking every number first. The $100 million operator is still the smartest person in every room. The $500 million empire builder built rooms full of people smarter than them in specific lanes and then got out of the way. That's the whole gap. It's not a bigger checkbook. It's a smaller version of you standing in the center of it. So look back for a second at the whole climb. Level 1 was $340,000 in a fourplex and a spreadsheet you built yourself at your kitchen table. Level 2 was learning that scale breaks the tools that got you here. Level 3 was the moment other people's money became the entire game, GP and LP, syndications, a track record as your only real collateral. And level 4 is where all of it becomes a machine, diversified, institutionally backed, built to outlast the person who started it. But there's one mistake sitting quietly inside every single level of this climb, the kind that doesn't show up on a balance sheet for 18 to 24 months, the kind that's already quietly costing operators 6 and 7 figures right now without them knowing it yet. I'm not naming it here. It's in the book and the link's in the description. Go find out if you're already making it.